There is a bill moving through the United States Congress right now that the banking industry says will close 175 million credit card accounts. Not reduce limits, not raise fees, close them permanently. And the people who lose their cards first are the people who can afford it least. There is a particular species of legislative proposal that arrives dressed in the garments of compassion while carrying, concealed beneath those garments, a mechanism of genuine destruction. Washington has a long and distinguished history of producing them. What is unfolding right now in the credit card market may be the most consequential example of that tradition in a generation. A policy intervention so well-intentioned in its rhetoric and so potentially ruinous in its arithmetic that it demands the kind of serious, unflinching examination that partisan cheerleading on both sides of the aisle has conspicuously failed to provide. The proposal is simple on its face. President Trump called for a one-year cap on credit card interest rates at 10%. Stating his desire for it to take effect by January 20, 2026. The headline writes itself. The applause was immediate and bipartisan, and the consequences, if the proposal becomes law in its current form, would land with devastating precision on the very Americans it claims to rescue. Let us begin with the numbers, because the numbers are what govern here, not the intentions. As of April 2026, the average credit card interest rate on new offers is 22.12%. with existing accounts paying an average of 22.30%. Total credit card debt in the United States has reached $1.28 trillion, while the average cardholder carries around $6,500 in debt. These are not abstract statistics. They represent real households, real kitchen tables, real conversations happening across America right now about which bill gets paid this month and which one waits. And when a senior citizen is carrying that average balance at that average rate, the annual interest cost alone approaches $1,450, money that services debt rather than buying groceries, filling prescriptions, or paying the electric bill. On that narrow and specific point, the populist case for a rate cap has genuine moral weight. The suffering it identifies is real. But here is where good intentions and ruthless arithmetic diverge, and the divergence is not subtle. The Electronic Payments Coalition's analysis found that nearly every credit card account associated with a credit score below 740 would be closed or severely restricted if a 10% interest rate cap were implemented. That would impact an estimated 175 million to 190 million American cardholders, primarily lower and middle-income households. J.P. Morgan Chase CEO Jamie Dimon called the proposal an economic disaster. J.P. Morgan CFO Jeremy Barnum said something even more instructive on a call with analysts. What's actually simply going to happen is that the provision of the service will change dramatically. Specifically, people will lose access to credit on a very, very extensive and broad basis, especially the people who need it. This is not ideology. This is the head of the largest bank in America describing, with remarkable specificity, what arithmetic requires. And arithmetic, unlike legislation, is not subject to amendment. The reason the math is so unforgiving requires understanding how risk-based lending actually functions, the mechanics that Washington's rhetoric routinely ignores. When a bank issues a credit card to a borrower with a 620 credit score, it does so knowing, based on decades of actuarial data, that borrowers in that risk category default at rates between 8 and 15%, depending on economic conditions. To lend profitably to that borrower, the bank must charge an interest rate high enough to cover expected losses across its entire portfolio of similar borrowers. At 10% interest with a 12% expected default rate, the bank does not break even. It loses money on every dollar it lends. And private financial institutions are not charitable organizations. They are not constitutionally obligated to absorb losses. They have exactly one rational response to a mandate that makes lending unprofitable. They stop lending. They close the accounts. They exit the market segment entirely. This is not cruelty. It is arithmetic. And the arithmetic does not care about the political intentions of those who wrote the cap into law. Now consider, with clear eyes, who populates the risk categories below that 740 credit score threshold. Federal Reserve Bank of New York data showed the average credit score for low-income Americans was 658, while it was 735 for middle-income households. The people who stand to lose their credit cards under a 10% cap are, in enormous proportion, the people the cap was designed to help. The senior on a fixed income who carries a small balance month to month to bridge the gap between Social Security payments and prescription costs. The family that put emergency medical bills on a credit card because there was no other option. and the average out-of-pocket cost of a 3-day hospital stay in America, even with insurance, routinely runs into thousands of dollars. The young adult just entering the credit system with a thin file, not through irresponsibility but through the simple passage of insufficient time. These are the accounts that close first. These are the people the rate cap abandons while claiming to serve them. If the first bill is a scalpel aimed at the wrong patient, the second bill, moving simultaneously through Congress, is a torch aimed at the entire rewards infrastructure that millions of Americans use as a meaningful supplement to their monthly budgets. The Credit Card Competition Act was reintroduced in both the House and Senate on January 13, 2026, with bipartisan support from Senators Durbin and Marshall and House sponsors Representatives Lofgren and Gooden. President Trump publicly endorsed the bill on social media, characterizing swipe fees as an out-of-control ripoff. And on that characterization, the president is not wrong. The average American household is paying over $1,000 each year embedded in the prices of goods and services to cover credit card swipe fees, the highest such burden in the world. Merchants pay between 1.5% and 3.5% on every credit card transaction, and they do not absorb those costs. They pass them into prices, which means every American pays swipe fees whether they use a credit card, a debit card, or cash. The structural reform the Credit Card Competition Act proposes, requiring large banks to enable at least 2 competing payment networks on each card, is, in theory, a sound application of competitive economics. Visa CEO Ryan McInerney called the bill harmful and unnecessary, arguing it would have far-reaching consequences at a time when the economy doesn't need them. But the industry's concerns about the bill's consequences for consumers deserve to be heard on their merits, rather than dismissed as self-interested lobbying, because the mechanism by which rewards programs are funded is directly connected to the fees the bill would reduce. Airline miles, hotel points, cashback percentages, purchase protections, these are not gifts from benevolent corporations. They are funded by interchange revenue. When that revenue is compressed through mandated competition, the programs it funds are the first casualty. And for the American consumer, who relies on 2% cash back on groceries and 3% on gasoline to stretch a tight monthly budget, the elimination of those rewards is not a theoretical inconvenience. It is a tangible reduction in purchasing power arriving at precisely the moment their credit access may be disappearing. If you are still reading and still watching, and I genuinely hope you are because what comes next is the part that actually protects you, then I want to ask you one favor before we continue. Subscribe right now. Because the developments on these 2 bills are moving fast, the legislative calendar is unpredictable, and when the vote comes, you need to be informed days before it happens, not the morning after. Every week matters. Every update matters. Subscribe now, and let's continue. The January 20th, 2026 deadline Trump set for the industry to comply passed without a single major bank reducing rates voluntarily. No federal law currently limits credit card interest rates, and any cap would require congressional legislation. The bill remains stalled but alive, and stalled but alive in a Congress with presidential endorsement and bipartisan sponsorship is a very different thing from dead. The sponsors of the Credit Card Competition Act, meanwhile, have indicated they will seek to attach their bill to larger legislative packages, potentially including the National Defense Authorization Act or a broader economic relief package focused on the cost of living. This is how consequential legislation often moves, not through a dramatic floor vote announced weeks in advance, but through attachment to a must-pass vehicle in the final days of a legislative session. You do not see it coming until it has already arrived. The cascade effect of account closures deserves examination in the specific because it reaches far beyond the simple loss of a payment instrument. When a credit card account is closed, whether by the cardholder voluntarily or by the bank involuntarily, total available credit decreases immediately, while existing balances on other cards remain exactly what they were. That shifts the ratio between balances owed and credit available, a number the financial industry calls credit utilization. Approximately 45% of U.S. households carry credit card debt from month to month. For those households, a sudden account closure does not just remove a financial tool. It triggers an automatic deterioration in the credit score that governs their cost of borrowing, the insurance premiums they pay, the apartment they can rent, and the mortgage they can refinance. One account closure by one bank as a consequence of one piece of legislation becomes a cascade that touches corners of a person's financial life they never anticipated connecting to their credit card. Consider the specific arithmetic of what this cascade produces. If you carry $9,000 in balances across 3 cards with a combined credit limit of $30,000, your utilization ratio is 30%, right at the recommended maximum for credit score health. The bank closes one card with an $8,000 limit. Your available credit drops to $22,000. Your balances remain at $9,000. Your utilization ratio jumps from 30% to 41% overnight. That 11-point jump in utilization can reduce your credit score by 30 to 50 points, with consequences that ripple forward into every financial transaction you attempt in the months that follow. And then observe the further cruelty the system delivers. As your score drops, the interest rates on your surviving cards can increase. Your auto insurance premiums can rise. Your ability to qualify for a refinanced mortgage, the transaction that might save you hundreds of dollars a month, becomes harder or impossible. The original problem was a 22% interest rate you could not afford. The consequence of the policy designed to fix that problem is a lower credit score, higher rates on remaining debt, and reduced access to every financial product that depends on creditworthiness. This is what the legislation's architects are not calculating in their press releases. For seniors specifically, the dimension of harm that receives the least attention in policy discussions is the most visceral. Many older Americans carry a credit card not primarily as a spending instrument, but as a contingency, an emergency fund in the form of available credit that compensates for the absence of liquid savings. A $10,000 credit limit is, for a significant portion of America's senior population, the entire financial safety net between a broken furnace in January and genuine hardship. Remove that card, and you have not adjusted a number on a balance sheet. You have removed the barrier between a retired person and the payday lender charging 300 to 400% annual interest on a 2-week loan. The alternative that waits for those whose access to conventional credit has been legislated away by people who were, with complete sincerity, trying to help. The question that should now occupy every person watching this is not whether these bills are good or bad in some abstract sense. The question is what you do about your own financial position while the political process runs its course in the direction it appears to be running. There are 5 specific actions that deserve your attention right now, and each of them produces benefit regardless of whether either bill ever passes. First, check your credit score today, not as a precaution against some distant possibility, but as a baseline reading before a situation that is actively developing. You can do this at no cost at annualcreditreport.com, which is the only federally authorized source for free credit reports, or through your bank's mobile application. If your score is above 740, you have meaningful protection from the worst of what account closures would produce, though you are not immune. If you are between 670 and 740, you are in the zone of serious risk, and the time for preparation is now, not after the legislation passes. If you are below 670, proceed on the assumption that your accounts will be affected and build your alternatives accordingly. Second, pay down your highest utilized cards with whatever you can redirect toward that purpose. This is not simply debt reduction. It is credit score management in the specific sense that matters most. The card that is 80% utilized is doing more damage to your score than a card with a larger dollar balance but lower utilization. Bring your most utilized accounts below 30% first, then aim for below 10%. The data on this is unambiguous. Borrowers with utilization below 10% average credit scores above 800. Third, do not close any credit card accounts voluntarily, even accounts you do not use. Every open account with an available credit limit is a structural component of your utilization ratio. An account you never use with a $10,000 limit is providing $10,000 of protective capacity in your credit architecture. To keep inactive accounts from being closed for non-use by the bank, make a small purchase on each one every 3 or 4 months and pay it in full immediately. This costs nothing and preserves the credit line. Fourth, begin building financial reserves outside of credit entirely. Online banks are currently paying between 4% and 4.5% annual interest on savings accounts. Even modest, consistent contributions, $25 or $50 a month, begin to build a reserve that belongs to you and cannot be removed by a bank's business decision or a congressional vote. The purpose is not wealth accumulation. It is the creation of a buffer that keeps a car repair or an unexpected medical bill from requiring an emergency credit card that may no longer exist. Fifth, establish a relationship with a credit union before you need one. Credit unions are member-owned, not publicly traded, and not subject to the same quarterly profit pressures that drive bank credit decisions at the margin. They offer more flexible lending criteria, lower average interest rates, and an institutional incentive structure that is fundamentally more aligned with member financial health than shareholder returns. Opening a basic savings account with a credit union this month requires minimal effort and establishes a membership relationship that becomes valuable if your bank account is closed under circumstances you did not choose. One final observation before we close, and it is not about legislation. It is about the predators who watch legislation the way sharks watch chum in the water. Every significant financial policy development produces, within days, a wave of scams targeting the people most anxious about it. You will receive communications, by email, by phone, by social media advertisement, that use the language of this situation to create urgency and extract either money or personal information. Your actual credit card company communicates through its app, through your online account, and through postal mail. It does not call you demanding immediate verification. It does not send texts with links to click. It does not create panic as a precondition for assistance. The manufactured sensation of panic is the scammer's primary tool, and the appropriate response to panic manufactured by a stranger is to stop, disconnect, and call the number on the back of your actual card. Americans' total credit card balance is $1.277 trillion as of the fourth quarter of 2025, the highest balance since the New York Fed began tracking in 1999. The people carrying that debt are the people most exposed to what is unfolding in Washington right now. They deserve analysis that is honest about the complexity, not reassuring about the simplicity. The rate cap sounds like rescue. The mechanism beneath it is something else entirely. Understanding the difference is not optional for anyone who carries a credit card in their wallet. What is your situation right now? What is your credit score range? And are you concerned about what these bills mean for you specifically? Drop your answer in the comments. The most useful question posted this week becomes the next deep dive. Your financial situation matters, and this community thinks it through together. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.